and welcome to the EisnerAmper Engaging Alternatives podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is Mark Hale, Chief Investment Officer of Prytania Asset Management, a securitized credit investment manager based in London. Today, Mark will share with us his outlook for investing in securitized credit transactions, including the greatest opportunities, challenges, and more. Before we dive into the conversation with Mark, don't forget to hit that like button and subscribe to EisnerAmper wherever you listen to your podcasts. And you can also find us on YouTube at EisnerAmper. Hi, Mark. Thank you so much for being with me today.
Thank you for inviting me, Elana.
Absolutely, Mark. So to kick off the conversation, tell us a little about yourself and how you got to where you are today.
Sure. So I read economics at university, and then I started my career at the Bank of England as an analyst and economist. I then moved to the sell side to do investment strategy and macroeconomic forecasting across a variety of investment firms before moving to the buy side in 1997 and starting off two portfolios to invest in ABS and CDOs at the time. In 2002, six of us decided to create a new independent specialist in structured credit, which was when Prytania was born. And we've been active in mostly public securitizations, with a part of our business being in the private credit opportunities.
At EisnerAmper, we are creative problem solvers that take a 360-degree approach focusing on you. We're an award-winning firm with decades of experience providing accounting and advisory services. EisnerAmper, let's get you ready.
So, Mark, given Prytania's focus on investing in securitized credit transactions, I wanted to hear your high-level overall outlook for the space.
Looking sort of beyond any sort of short-term volatility we might see, the market continues to grow and develop. It's broadening and deepening. New issuers are coming to the market all the time, as well as an ever-increasing investor universe across the globe. We see pretty favorable supply-demand dynamics right now. With those increased investor flows, both institutional and private client investors increasing their allocations to structured credit, seeing it as a complement or alternative to private credit and traditional fixed income. We've also seen the advance of technology and how platforms have come in to broaden access across the sort of more retail client base, particularly, of course, noticeable in the boom in ETF investments in recent years. And looking sort of behind the headline numbers, we see still better transparency over the last 2 decades with improved data quality. And all of that, I think, reinforces people's comfort with the asset class and desire to increase their asset allocations going forward.
And Mark, as a follow-up, why is structured credit relevant to investors across the globe?
In part, it's because it offers yields that one can't find in comparably rated corporate bonds, whether that's in the investment grade or the high yield universe. The product has bankruptcy remote structures and enhanced structural robustness compared to conventional assets. And in a time of uncertainty and concerns about low growth and recession in different parts of the world, that provides a good deal of comfort for investors looking for higher returns, but also higher risk-adjusted returns. The products offer a significant diversification benefits. You get access to a huge number of obligors, a very wide range of sectors, including sort of parts of the economies in the Western world that it's not easy to buy directly in public form. We obviously have a relatively transparent and data-rich environment, particularly compared to things like private credit. I think furthermore, you've also got the evolution in the issuer base. So there's a constant sort of widening in the range of opportunities that investors can access at their desired sort of price and risk points.
Mark, on the other hand, what are some of the greatest challenges you face in your space and why?
It's a very great question right now. I think obvious concern are sort of macro and geopolitical right now. we face a very significant degree of uncertainty in many parts of the world, not least in the United States, in an environment whereby it's very hard to know what the risk-free rate should be, in a world whereby the rate setter and liquidity provider of the global financial system is operating sort of independently and in its own interests. It's obviously also leading to further debasement of the dollar. And at the time, in particular, we see now in Washington the rise of big government and interference in processes such as monetary policy with the attack on the Fed. So that's a very uncertain background. In terms of our own sector, we have suffered, particularly since the GFC, from adverse regulatory interference. That continues in many parts of the world. It may be less acute than it was immediately after the GFC, but it's still an ongoing concern. And you can never sort of sleep soundly with those sort of underlying threats to the financial system, or in general, or structured credit in particular. Looking down at our sort of business and the assets under management, I think sort of liquidity, appropriate position sizing, and portfolio construction are all sort of critical factors. Liquidity risk being the most difficult to measure and anticipate, and indeed to manage as a relatively small player in a vast global ocean of capital. And I guess on a more microeconomic level, clearly at a time when households and businesses are becoming more cautious about spending, we have to look very carefully for signs of stress building up in the underlying collateral data of the securitizations that we invest in.
Mark, we've covered a lot of ground today and wanted to see if you have any final thoughts you would like to share with us.
Structured credit has matured now into a resilient market with a huge range of opportunities. You might say we're no longer a child, no longer an adolescent perhaps. Maybe we're in a young adult phase. We haven't become fully mature, but over time, that process by which the market becomes not a small sort of little understood segment, but already a major part of the global investment universe, with potential to become still more important. The reforms that we've seen in the markets have made it safer and more transparent. And this is a great place for investors who are looking for income diversification and also capital preservation. And at Prytania, our focus is to try and manage the best opportunities in this sector for our client. The economic cycle waxes and wanes. And as new opportunities present themselves through innovation and that widening in access by a whole range of issuers across the globe.
Mark, I wanted to thank you so much for sharing your perspective with our listeners.
Okay, thanks for having me, Elana.
And thank you for listening to the EisnerAmper podcast series. Visit EisnerAmper.com for more information on this and a host of other topics. And join us for our next EisnerAmper podcast when we get down to business.